Hey guys, this is Bruce Marshall from Simpler Trading with the nightly premium video for Wednesday, October the 25th. And this was another day. We've had quite a few down days lately. We hit a new record in the NASDAQ on the downside for the year. That's not good. So it is turning out to be a typical October. So we'll jump into it, take a look at what's going on, kind of what I'm looking for. We're right in the middle of earnings season, which kind of makes it even more interesting. So let's jump right in and see. I'm going to move this out of the way. This is the NASDAQ. This is the rut. Let me take those out of the way. And so what I've got here, this is the ES opening print. This is the overnight session. The light gray, the black is the cash session, and we just rolled off immediately and got a head fake here. I thought maybe that's it and we're going to go this way, and then we just kind of drifted all day long. This tree line down here around 4200, it did sort of hold, not exactly, but 4200. Now this is ES, not SPX. And then we tried to make a half-hearted attempt up here into the end of the day, because after the close today, we had a Meta report, which I guess is the the biggest name, I suppose. I haven't even looked at it. Obviously, flush down, flush up. It is higher by about 8%. Excuse me, 8 points. So that's looking pretty good. So that was one thing we were worried about. So we're, as we're getting into the tech stock earnings and, the Magnificent Seven, as they call them, we have had Netflix up. I'm trying to remember this. Netflix up, Microsoft up, Google down. What else was down? Tesla down. So we've had two up, two down. Meta appears to be up. We've got Amazon tomorrow, and then we've got Apple next week. So that's the Magnificent Seven, and it's a very mixed bag. So there's no real surety either way, up or down here. But one kind of thing that it was interesting, we've been talking about. I heard Neil mention this too. I'm a fan of IBM here, and let me switch this over. For several reasons. They had a good report this time. I want to say, I can't remember how many years, what the low is or whatever, but so far so good. That will help the overall market, I believe, a little bit. We have a lot more earnings coming out in the morning. We've got Tractor Supplies, one of my I like to trade. I like to go in there. It's kind of a cool, if you like going to Home Depot, it's similar. Northrop Grumman, the defense stocks, of course, have been doing good. We got UPS. That'll be another one that's going to show strength of the economy or not. And then after the close, of course, Amazon and Intel. Intel doesn't move things like it used to. And then Chipotle is a good indicator of the consumer and all that kind of stuff. So anyway, lots more to come out in the next week or so, and then of course you got a Fed meeting. But let's look at what's going on here. So if we look at the NASDAQ here, I didn't even know this until I was reading the news at the end of the day. So you see this high 16,062, which is in kind of late July here. That high to this low, it just crossed over 10%, so that's considered a correction. 20% is bear market, so this is, we're halfway there. Not good. That's not good. And we're also, if you notice this, if you use this is the Darvas box and grab candles. If you notice, we are breaking below this Darvas box. That's not good. That kind of opens up, for more downside. These are 34 EMAs, and once we're below those, as we are, they typically will act as resistance on the way up. So you could get this kind of thing. I don't know. It's too early to tell, because we could come out with Amazon tomorrow and they could crush it, raise guidance. Apple could do the same. Kind of not as confident with Apple, but we'll see again. But again, we're kind of in a really tricky place here with the overall market and the NASDAQ being sitting perched right on the edge of a cliff, could fall this way or not. Now, one thing that's driving this, if you guys saw this today, the 10-year, look at this, 105. I mean, that's brutal. Rate hike, rate hike, rate hike, rate hike, rate hike. Price down, yield up. So the 10-year yield went over 5% today. That will suck a lot of money out of the market, honestly. And the thing about it, if you listen to Jamie Dimon or some of these guys saying that rates are going to go to 7%, I don't know if they're talking their book or not. But either way, if that were to happen, definitely not good for the market. So we need to be keenly aware of that. If you've been listening to me in the rooms, we've been hedging on both sides. I'm going to show you a hedge in a second. Two hedges, actually. I am still net long overall, and thinking, now this is going out further in time, thinking that I don't think anyone really knows at this point, because we've got earnings. We've got earnings and a lot of earnings coming out tomorrow, Friday, all next week. But guess what? Next Wednesday is Fed meeting. Now we know, I haven't checked the Fed Watch tool today, but there was a 98% chance of no rate hike. And they keep kind of kicking the can down the road, which is good. And I'm reading that they think that inflation is going to kind of take care of itself, perhaps. But the Fed says if data keeps coming in strong like it did in September, there will be a need for more rate hikes and all that kind of stuff. So, the thing about it, if you listen to what they've been saying, we were, I didn't, but we were told by the market that we're going to get 2 rate cuts by the end of the year, and I laughed and laughed. I said that's just not going to happen. And now they're saying maybe we get 1 by the end of next year. So that's kicking the can down the road a good bit actually. But the market is forward looking, and all this stuff can change pretty quickly. So I don't want to be all doom and gloom. Again, I'm net long, but that being said, whenever I am really long or short, I try to sell premium around the position to minimize the cost and all that kind of stuff. It's pretty rare that I put a big position on that's got full exposure to one side or the other, unless we're in the right type market, and we're not in that type market right now. I'll show you the right type market. If we're in, let me get my drawing tool. If we're in this market, pedal to the metal, we're going to buy the dip and we're going to go big or go home, right? This market, yeah, kind of same thing. I think, actually, that was my best year right there, I think, personally, and for bias in that down. We shorted. We were down. This was a great year. These were great years as we're going up. This was pretty good here. I've said this over and over. This is the Charlie Brown market. It's just up, down, whatever. There's no trend, there's no pattern, all that kind of stuff. Very clear to see when you look at a 5-year chart. It's definitely tradable. We're still doing good. In bias, I'm up pretty nicely for the year, but it's a lot tougher. You've heard me say this over and over. It's a lot tougher than it normally is, and all that kind of stuff. You got to be more nimble and quick and all that kind of stuff. And I'm also working a lot more both sides of the market, being I'm bullish, I'm bearish, I'm bullish, I'm bearish, or both at the same time. Meaning maybe I'm bearish, but I'm selling premium on the upside to pay for the bearish position. I'll show you in a second what I'm talking about. Doing that a lot. And it's working, and you have to do that in this kind of market. That's just the way it is. You have to shift into, an old mentor of mine told me one time, trade the market that you have and not the market you wish you have. Which means we all love those long trending bullish market where you just buy the dip. It's pretty easy. You just pull back to 21, you just buy it and that kind of thing. That's not what we're in right now. So it takes a little more, you got to get a little more creative, and you got to get a little more involved in trading and all that kind of stuff. So let me show you an idea here. I actually have been using the diamonds for some hedging as a broad market kind of surrogate. And this works better if you've got, if you've got the Dow stocks, but if you've got a retirement account and say you have, consumer staples and value stocks and things like that that are sitting in your account and you just want to hedge them, that kind of thing. That's what I've been doing for a pretty good while, actually. You could do the same thing. I'm going to show you an example in the Qs as well. You may have seen this already if you're in the main room, because I've been talking about this for weeks and weeks and weeks. But on the diamonds, I set up. So what I've been doing, basically, I'll give you the quick 10-second talk here. So I like to use the Darvas box and grab candles. This is a 34 EMA. It represents very close to the time frames that I trade. So for me, if you look at this and you go, this won't do me any good because I'm scalping futures and I'm in and out in 15 minutes. Well, that's not really what I'm doing here. I'm just talking about hedging an overall portfolio or taking advantage of a downtrend like we've been having. Now, for the shorter term stuff, yes, I do that, but we're going to much shorter time frames, and I'm using fib levels, and I'm using I use dynamic traders, so I'm using Voodoo Line's fib levels on really much smaller time frames. But the gist is, come into a Darvas box as support. You bounce back up into 34 EMA. We did clear it a little bit there. Come back down. We did pass it a little bit on the downside for the next bounce up. We passed a little on the upside. That's not too normal. Came back down here and the trap door open, right? Boom, 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 and then we came back up right to 34 and back down again. So every time this thing bounces up, and I could do this on any index. You could do it on S&P, SPY. I really want to do it on the IWM, but we really haven't had a chance. I'll show you a chart of the IWM in a second. But anyway, following this pattern, I have been fading the diamonds. So I set this up in the main room about a week ago or so. So here is the trade. I did an unbalanced butterfly here. So see, it's a 1x3x2. And we put this on. We were about 340 in the diamonds. Let me see where that is. 340. Yeah, so I was trying to fade it from, you guessed it, that upper 34 EMA. And that was about, I think that was right there is when we put that on at 340. And let me pull this back up. So, and I did this, I posted in the room as one contract. You can do as many as you want, but remember it's an unbalanced. So if you do, say, 5x10, that's here you're risking 1,700, 350 times 5, 1,750. You're up $1,800, etc. But I post this as a one lot because everybody can size to their own account size or preference or whatever. But a 1x2x3. So this thing is up 360 something bucks. So this expires on 10 November. I wanted to get past the Fed. I wanted to get past earnings season, thinking that maybe we bounce a little bit and continue on the downward spiral, right? So 350 of risk up here on the downside, 950 if we overshoot it. My target the entire time has been 320 to 330. Now we're entering into that right now, that 330 kind of zone. I know some people today told me that they were going to go ahead and take profit. It's actually more than this. I don't know why that T+1 line has dropped down a little bit low. It's after hours, so the quotes are kind of off usually. But anyway, that's an example. The way that I leaned this, I wanted to get as close as we could to the current market price at the start of the trade, and that puts us immediately in the money if that's what happens. And we got tiny risk here. All right, so the next one, I was in the main room yesterday, and someone said, what if I'm long a bunch of NASDAQ stocks? How do you hedge this? And I said, we can use the NDX, but I kind of prefer to use the Qs. You could do either one, NDX or Qs, or in NASDAQ futures. But for a simple way to do it, I set up this butterfly. Kind of the same thought process. Now I set it up two different ways. I set up at first I was going to duplicate or replicate, I guess, the diamonds trade and do an unbalanced, a 5 by 10 by 15. And I set that up and I started doing the math. How much are we risking here? How much are we making here? Etc. And this is going to 3 November because I wanted something that's just going to get me past earnings in the Fed meeting, right? And I set up this regular butterfly here, a 1 by 2, 1 by 2 by 1, right? Regular butterfly, and it was much less cost, much more bang for the buck. So on for example, a 10 lot, $1.38, that's $1,380, and your max profit down there is $3,600, and all he has to do is go down. Now that would be to hedge again if you're long some NASDAQ stocks or even long some option positions over earnings, right? So you can be long. I want to try to be long Apple. I want to try to be long Microsoft, whatever. I want to be long Google. Okay, you got a bullish call debit spread on Google. Well, that didn't work. Well, this did. This is your backup to hedge basically any of those stocks using the Qs, right? And if you're wrong, so you got 5 or 6 long positions, whatever, 2 or 3 of them don't work, you're making money here, and it just hedges you. And I'm watching the deltas too, because especially if you're using stock, you can tell how much you need to short. Or we even talked about actually just shorting the Qs, and again, that little flush down made $1,000 if you were to short this 150 shares. Not a big deal, but does take a lot of margin. But that's another way to do it, and it's by watching how many deltas you have long, how many shares you need short to offset the risk. And the way it looks is, if you're long 150 deltas this way and you're short 150 deltas, you're kind of flat. If you're just not sure, and the point of doing something like that is to put it on before earnings, take it off the next day or something like that. So in this case, it worked. And maybe if you're long whatever Google, you're getting smoked right now, you keep this on and it keeps going down, or you take off the Google and you can still keep this on, whatever, but it keeps going down, you keep making more money. So anyway, you guys know how to do this. I think we talked about it a lot in the main room. Pretty simple, straightforward kind of stuff, but it's more and more important to do that now and be ready, because I'm telling you, this thing bounces back up, I'm gonna add another one of those butterflies on in some fashion, maybe a vertical. I don't know, we'll see. It depends. I price it out each time, right? We bounce back up, I'm gonna assume this thing is gonna keep going down until I'm proven wrong. And I'm more willing to do that in the ES right here. So on a bounce back up to here to here, that range, I'm going to assume it's going to keep coming back down for the time being. Now, at some point, I am long up here into the end of the year, and and I'm looking at going out to January, February, March, probably something like that, far out with small size, not a lot of money on it, right? So I want to be short in the short term. I want to be long in the long term, right? That's an easy way to remember it. And one last one is the rut, or the IWM. Holy moly, look at this. Smoked on the downside. I mean, I've been trying to short this thing for weeks and weeks and weeks. It can't even get enough of a bounce to get it that interesting to even short it, but it just keeps going lower and lower and lower. So we'll keep an eye on this one. And I would, honestly, at this point, I would consider maybe even try to nibble long back up to these kind of levels. I'll let you guys know when I do it. But I'm not quite brave enough to do it yet. It would be with small size. It would be one of the trades where we risk, 200 to make 800 or something like that. But we'll see. Anyway, I hope this helps. We're still in limbo big time right now. We'll know more after tomorrow, and Amazon reports after the close tomorrow. And then, of course, next week, hold your breath into Fed. I don't think it's going to be a big deal because they're not going to do a rate hike. But the language is going to tell us a lot, and that can make us go either way. But also keep your eye on the Middle East. Keep your eye on the bond market, all the stuff we're juggling. And the market, in a lot of cases, climbs the wall of worry. This time it's selling off on the wall of worry, kind of all the way down. So we play it in that direction until we're proven wrong. So thanks for your time. Hope that helps. Let me know if I can help you. I'm in the main room a lot. If you're not in bias, jump in the bias room and check out what we're doing there. We're still doing a lot of trades, and for the most part, they're working pretty well. So anyway, again, keep your eye on your trades. You got to be a lot more involved now. You got to be a lot faster to defend and get out and take the money and run and all that kind of stuff. So with that, let me wind it up. Thanks for the time, and I'll talk to you soon. Take care.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me.